Many small business owners have a profitable main business, but might be losing money on a side project or a new venture. Sound familiar? Well, here's a question. Are you still paying full taxes on your main business income, even with those losses? If so, you could be leaving serious money on the table, and we're going to talk about how to fix that. To understand how this works, we need to talk about two types of income, active and passive. Well, active income is money you earn from a business you're substantially and regularly involved in. For most, this is your main business, the one you work in, day out. Passive income, on the other hand, comes from activities where you're not materially participating. Think about a rental property you own or another side business you only spend a little bit of time on. Losses from these passive activities have certain added restrictions of use compared to losses from businesses you're actively involved in. So here's the key tax rule that you need to know. You can generally deduct active losses against your active income without limits, but passive losses are different. They can only be deducted against passive income. So if you don't have any passive income, those losses are often carried forward to future years. For example, if you spend a few hours a week managing a rental property, the IRS will likely consider any losses from it passive. So if that rental loses $10,000, you probably can't just subtract that from your main business's profit. So what can you do? Well, tax rules may allow you to group certain active and passive business activities together for loss recognition rules. If you can show that multiple businesses form a single cohesive economic unit, then the time you spend on all of them can be combined. And by grouping them, you might meet the requirements to classify the entire group as an active business. And this can turn those previously limited passive losses into fully deductible active losses, which can directly reduce your tax bill. It's a strategy that requires careful planning, including detailed tracking of your activity as the owner and possibly tax return elections. Reach out to your accountant or financial advisor if you need some help. Looking for more small business finance tips? Subscribe to our channel today.